Hello, I'm Teri Cohan Link, principal of LINKCO. Welcome. Good afternoon, good evening, and good morning for those of you joining us from other sections of North America, Europe, the Middle East, and Asia. Please let me know in the Q&A box if you can hear and see me. You might notice that this is a slightly different format. I have just transferred over to Zoho, and we are using another one of their video conferencing tools for the first time. So please bear with me, although I don't anticipate any glitches. Let me just check and see let me know if you would be so kind as to let me know you can hear me and see me. Thank you. All right. Thank you for attending the webinar, Is Your Business Going to Thrive, Survive, or Die? With Ron Ainsworth, principal of Boustead Company, whom I will introduce in a few moments. This webinar is part of a series born out of insights shared by business leaders during conversations about the current and dynamically shifting COVID-19 business climate. The conversations resulted in a timely white paper entitled Realism, which LINKCO recently published. This is my way of giving back and sharing relevant information I learned speaking with business leaders on a day-to-day basis as part of my ongoing executive search practice. These anonymously shared challenges, lessons learned, and opportunities identified are highlighted in the white paper. Just let me know in the Q&A box if you would like a copy, and I'll send it to you via email. In the wake of COVID-19, many of the respondents have been grappling with changing economics related to their assets, products and services, remote workforces, new challenges of workflow and timetables, particularly now with the second wave of COVID-19, how to evaluate risk, work product, best practices to reassure clients and protect employees, protect assets, and keep everyone safe, cybersecurity and privacy from off-site locations, how to lead remotely with loved ones, sharing workspace and unanticipated demands on normal work time. To note but a few of the insights, disruptors, and challenges discussed in the white paper. Today's webinar focuses on how we manage our business growth, success, and assets. How and what the principal of a mergers and acquisition firm and his team advise their clients in order to thrive, pivot, and or let go of unprofitable assets, provide valuable insights as we lead our companies during and beyond the pandemic. The upcoming webinar in this series is The Dramatically Changing Office, and that will be with Chris Mays, the Los Angeles Managing Partner, Moore Partners. This webinar will be in 3 weeks on August 26th at 2 p.m. A little housekeeping. Some of you have kindly shared your questions beforehand, and we have already included them in the queue. You may also send questions and comments in the Q&A or the chat. And if not covered already, Ron will try to answer those questions during our session. Now let me introduce our speaker. Ron E. Ainsworth, principal of Boustead Company Limited. Ron has been involved in mergers and acquisitions, capital markets, financial restructuring, and business valuations for over 35 years. Mr. Ainsworth career experience encompasses 400 plus domestic and cross-border transactions, totaling over 15 billion in value across an array of industries, including food services, healthcare, manufacturing, apparel, and technology. As the CEO of Trenwith Securities, Inc., Ron partnered with BDO, the world's 5th largest accounting firm, and grew Trenwith's footprint to over 135 offices across 110 countries. Ron ran Trenwith BDO for 10 years, during which he worked with his partners in Latin America, Canada, India, and China to develop an international M&A and corporate finance business. He served as chairman while expanding Trenwith China presence with the development of a wholly owned foreign enterprise, Beijing, China. During this period, the firm conducted hundreds of transactions with prominent Fortune 500 companies and established relationships with a variety of international capital providers. In 2008, Ron sold his interest and pursued a variety of personal investment projects. Ron currently resides as a principal of Boustead Company Limited. Boustead Company focuses on providing mergers and acquisitions and capital markets advisory to the middle market. Now, let me just make sure that I am making Ron the presenter. Give me a second. Okay. Ron, I think you need to put on your video now.
Okay. Okay, can everybody see that?
I'm not seeing it. Let me just see about.
Let me see if I share.
Yeah, you may have to share.
Did it come up?
No.
I'm sharing.
Do you have a little, there we go. Hello.
Perfect.
And we should, saying presenter is choosing to share the screen. Bear with us for a second. And I'm not seeing the PowerPoint. Are you seeing it, Ron?
Yes.
Perfect. Okay.
Can you see it?
I'm not seeing it, but can somebody in the chat box just let me know? Yeah, no, we're not seeing. I'm not seeing it. I don't know why.
It says my entire screen and share. Let me try again. Cancel.
It says please wait. I don't know why.
Did it come up?
Somebody let me know. I'm not seeing it.
Huh. I'm not sure why.
Yeah, I don't know why either.
It's definitely just worked okay yesterday, right?
I know, it did. It worked perfectly.
Can you see me?
I can see you.
Okay, so let me go to, can you see that? Is it up?
No, it isn't. I'm going to try one other thing. Just give me a minute. Sorry for the slight delay. I am going to mail this to somebody that I think will be able to get it up really quickly. Just give me a second.
And Teri is telling me that the screen sharing is denied.
Is denied?
Yes.
Huh. Okay, let me go back. Trainers. No, not with me. That's just so strange. Let me just 1 second. These things, unfortunately, happen at times. And
Yes.
I apologize, but we'll get there. Hopefully faster. Okay. Okay.
Can you see that?
1 second. Let me get back. Yes. What did you do?
I don't know. It's just that time it let me go through.
Oh, okay. Perfect. Can somebody just let me know if the audience is also seeing that now? Yes. I got a yes. Awesome.
Perfect.
So great. Thank you. And thanks for your patience, everyone. Ron, to get us started, after many years of working in investment banking, what keeps you interested and how have your insights and lessons learned influenced Bousted's company's culture and approach to its clients?
Well, I think after so many years of doing it, it really is about sharing your knowledge with the people that you get the pleasure to work with. I still get to meet hundreds and hundreds of different companies every year. It's always exciting, the type of things we get to see, and the people. It's really a people business for us. We're in the service business, even though we're investment bankers. We still provide a service, so it's something I think you have to really enjoy and like doing. And every company has its own situation or its own problems that you have to figure out. So it's just as challenging today as it was in '81 when I started out.
Thank you. Please continue.
Okay, thanks everyone for giving me a little bit of time. And I would say up front, this is meant to be a conversation. So stop at any point in time. If you have questions, I'll be happy to share. So really wanted to do is look at some, common sense strategies for a very uncommon times. What's the new normal for us? We definitely see interest rates are going to remain low. It could be low, it could be even below zero. Other countries today have below zero rates. I'm not sure if we'll get there, but it certainly will maintain, the low rates for a while. The global supply chains are being really unwound as pressure on domestic products increase. So we're going to continue to see more pressure to bring products back home. It's unforeseen how well that's going to work. We're still not the cheapest labor around the world, so it's a great idea. We'll see how it works. The other things we're seeing is the largest increase in government debt since World War II. The pressure that this is going to put on the economy and the government is something we really don't know today what the outcome of that's going to be. I think slower economic growth, less capital allocation, higher taxes, higher labor costs is going to continue to add pressure to companies' margins. It's going to get more and more difficult to maintain your margins and stay profitable. And I think the last is because of the globalization decrease, I think costs are going to rise. It's going to be less cheap labor and continued higher tariffs. Just kind of a snapshot of what the M&A market looks like today. We've seen a real decrease in the deals. That goes without saying. People are taking a wait and see attitude. We've seen a decrease in capital investment. The same thing. Private equity firms are paying more attention to their portfolio and trying to make sure that they can shore up their own investments before they start looking outside. Some interesting sides that we've seen is the size of the funds available. The dry powder, as you can see, is at an all-time high, was $500 million. There's a lot of dry powder out there that's going to be looking for deals whenever this market begins to turn. One of the other things that I saw that's pretty interesting, that's not on this chart, is how little funds they are today. Last year in 2019, there was 660 private equity funds. This year, when we looked at it, there was only 222 private equity funds. So there's been a real decrease in the number of funds and a real increase in the amount of dollars. And with this, Teri, I'll stop and see you had a couple questions.
Thank you. Yes. How do you take advantage of the deglobalization as we grow our businesses?
Well, I think it's going to be very binary. There's going to be a lot of transactions like medical healthcare. A lot of that will come home because it's where it should be done. But there's just a lot of these businesses that the cost of labor, the cost of manufacture, the cost of goods, it's just not going to work in the US. I think there'll be a lot of these businesses that will never come back again. So it's very binary. It's not going to affect everybody the same way. If you have a product, if you're in technology, if there's things that you can bring back to the US, I think there'll be a real push to do that. But again, the cost of those goods are going to be tough to, for the middle market people to bear.
Here's another question that came through. You noted that larger deals are getting funded. Why is that? And are there exceptions? And if so, why?
Larger deals historically are always easier to get done. I mean, when you look at the different pricing metrics between a $10 million EBITDA and a $70 million EBITDA, the safety on a $60 million EBITDA is twice or more than on a small company. Smaller companies have less flexibility if they get in trouble. And so, it's tough for those types of deals to get done, especially when you're in uncertain or uncommon times like we are today, because the risk to these companies, it's pretty hard to get your arms around it. So big deals, always easier to get done. $60 million EBITDA. Even if I lose $20 million EBITDA, I'm still at 40. So I still got a lot of room to go. So that's primarily why we always see the bigger deals.
Please continue, Ron. I'll get back to you with some more questions.
Okay, so we looked at the thrive and survive and dive part of the business. I read some reports that basically two factors were looked at the business operations. One of them is the timing of the service. The other is the location dependency. How dependent on the location are you? So if you look at companies that are going to dive, that's going to have a hard time surviving COVID-19, they're basically businesses where the customer and the provider need to be in the same place and the same time. That's going to be a tough model in the near future. And I'll provide you some examples. Companies that will get by and just survive are companies that customers and service providers need to be in the same location, but not at the same time. Other customer providers do not need to be in the same location, but need to be together at the same time. Those combinations are still going to be tough. So what are the companies that are going to survive and thrive in the next 2 or 3 years here? Companies are going to thrive are customers and providers that do not need to be at the same location at the same time. So what do we mean by that? So if you look at companies that are going to die, that's going to have problems, tour operators, cruise ships, bars, dining and restaurants, concerts, sporting events, all of those where your service has to be and the customer has to be in the same location at the same time. Companies that will survive, they're going to struggle, are self-service stations, independent tourism, drive-through restaurants, laundromats. Those are things that will survive. It's going to be tough, but they will survive. So what are the areas that can really thrive? Well, when we look at the online streaming, when we look at online delivery, when we look at video, entertainment, social media, restaurant deliveries, grocery deliveries, professional services, telemarketing, All of those are posed to basically really do well over the next couple years in this market. Here, did you
Okay.
have a question?
I do. It goes back a little bit, but it's highly connected. How do you explain the disconnect between the stock market and the real economy? Do you see a correction before the election?
Wow. That, now I have to put my, my hat on, right, to figure out. You know what? Right now, when you look at the markets, I mean, basically, they have kind of still priced in a recovery. Obviously, the markets don't see this getting as bad as, some people think it can be. So the real question is the market going to wake up to the fact that this is going to get a lot worse before it gets better? Because right now, when you look at the way the markets are pricing it, they're seeing a recovery next year. Clearly, we don't see how that could happen, but the market obviously sees some kind of recovery next year. Once they wake up to the fact that there probably won't be a recovery next year and it can get a lot worse, then there'll be a correction in the marketplace. And will that happen before the election or after the election? It's probably anybody's guess, to tell you the truth, Teri.
Okay, and here's another follow-up question. If a company, okay, so what advice are you offering to your client companies in the dive survive categories to consider? If you and they are analyzing together, here's where we're at based on some of the analysis that you've just shared with us.
Well,
what steps should they be considering?
Coming through a lot of the turn downs and have done many, many bankruptcies and restructuring, the first thing we really try to look at is, does this business, can you get the business to a break even? That's the first survival step you need to take, because if you can't get it to a break even, you're really just throwing good money after bad. And you're basically taking the risk that this thing will come back and you'll be able to save the business. So we never like to throw good money after bad. So you really want to analyze the business and say, look, does this business model fit in a survive mode, or does it fit in a thrive mode? And if it's in a dive mode, you really just want to cut your losses and wait it out, is basically what we tell people.
And if they're waiting it out, any suggestions as to how they should be doing that?
There's, it's always liquidity. Liquidity is king. So,
yeah.
You keep your liquidity, you keep your dry powder, you stay on the sideline. There'll be a lot of consolidation in these markets. There's going to be hundreds and hundreds of companies that will consolidate. So you really want to be in a position where you can take advantage of the low valuations of the consolidation of these marketplaces. And really the only way you can do that is keep your liquidity.
Okay.
There'll be a lot of opportunities coming down the road. I mean, we've seen every recession we've gone through, we see as much or more money made after the recession than before, but just because of the size of the opportunities.
If a company sees themselves potentially hitting an untimely exit, what actions or strategies should they be employing?
Well, they're a lot of the same that we're seeing here, right? I mean, that we just talked through.
Yes.
And let me move to some of my next slides. Here's some of the things. If you're looking at your business, what we say to business owners today, you should look at is analyze when and where your business needs to operate. How important is the timing of your service? Can it be changed? How important is the physical location? Do you really need to be in the same place at the same time as your customers? Can you achieve the same outcome if the time and the place were different? What parts of your operation could become less time and location sensitive? And then you want to look, is there a path? Is there a strategy to become less time and location sensitive. Those are the things that you really want to look at your business and see how you can gravitate to more of a thrive business model. We went back to the 30s, to the first recession we've had. So there's been about 12 since then. And so what we took a look at is what was the average downturn if you get caught in an uncertain market, and what kind of effect can it have on you? So what we see is historically, the average losses in value was about 48% if we average all the downturns. And the average recovery time was 2 to 5 years. So if you're looking at a business model and you're thinking, how do I survive? Well, certainly you want to plug these numbers in, because you need to be able to make it for the next 2 to 5 years minimum. And you need to be able to survive a 30, 40 plus depreciation in your valuation before it's going to come back. So this is some of the things we look at that an uncertain market is going to look like and feel like. I think your question is untimely exits. Why are they problematic? Well, they're problematic because they have a negative impact on the shareholders and owners and your employees. So what causes them? What is potential triggers? Certainly capital costs. You're undercapitalized, going back to the liquidity issue. There's loan defaults. You're going to see a lot of loan defaults in the fourth quarter of this year. There's partners disputes. There's divorces. There's dissolutions. All of those things will cause the owners or shareholders to have to exit the business at the wrong time to maximize their valuation. Some of the other things we looked at is consequences of those exits. You're going to be forced into an uncertain market, typically at a lower valuation. It's going to be a higher dilution, and you're going to be selling on buyer's terms. There's no choice in the ownership structure, and it's tough to walk away. Again, those impact the owners, the shareholders, and employees. Capitalizing your company. Going back to what I said a little bit earlier, there's always a tremendous amount of money and opportunity created in these downturns. There's going to be consolidations. There's going to be a lot of businesses that will have to change their business model. So if you want to stay in the market and you want to stay in the business, you really need to focus on capitalizing your business so that you have the staying power to get through a 2 to 5 year period and withstand the kind of devaluations that you may see. The opportunities for that is you can choose when you want to enter the market. You can choose the ownership structure because you're the buyer and you're capitalized. You can exit at the top of the economic cycle instead of the bottom. Generally, you're going to maximize valuations. You're going to minimize your dilution, typically on seller's terms, and higher liquidity potential in the marketplace. So there's a lot of reasons why a lot of these businesses will really do very well, because they're well capitalized, they got a balance sheet, and they're going to be able to take advantage of these markets. There's universities, I think it was Arizona and Louisiana, basically studied 4,500 companies that hired an investment bank. And what they found was, on average, by bringing in a third-party investment banker, they achieved multiples or prices of 5 to 20% above what was gotten without a banker. We also found that 84% of those owners felt like it was value added to bring a banker in. So that's just a little commercial on investment bankers, right? So what's the options for management? If you're going to sell, if you're going to raise capital, what do you do? And we always say, look, you do have options. You can do it yourself. What we find is when companies try to do it themselves, it's very distracting. It takes a lot of time, a lot of meetings, and a lot of calls to basically achieve these events. So we find that generally management will end up with a lower valuation. they will invest a lot more time, and there's also unforeseen risk. So the other option would be hire a bank, bring a banker in. What we found in looking at that is it's a lot quicker, generally 6 months. We will achieve higher valuations, generally less time of management investment, and you bring in for professional oversight.
Ron, I have a question.
Okay.
So at what stage should a company begin to engage with an M&A specialist? And from your vast experience, what would be a productive pathway for a company to strategically be thinking about doing so?
Okay. Look, in one sense, as bankers, we're in the meeting business. I mean, that's what we do. If we stay in front of people, if we're in front of companies, things go well for us. And so we offer a lot of free advice. We like to position companies. We say to management or owners, if you're thinking about a potential exit, even if it's a partial exit, if it's a recapitalization, you need to get a couple different sets of advices early on. One is taxes. What is going to be the tax hit to, to the company and to management? How much money is going to need to be generated out of this sale for the owner to maintain his standard of living long after the sale's gone? Always need to look at that. Also, they need to get legal. So those are the people we say you should engage in early to talk, so that you really know what happens or what's going to happen. I've seen too many busted deals where, we got the company up, we got a term sheet for, let's just say, $30 million. The owner's happy, he thinks he's going to get 30 million, and then he realizes that there's taxes out there, there's fees, there's all this stuff, and he realizes he's only going to get 11 or 12 million dollars, and then the deal blows out. So we really push to do that early. Look at that early and see what is the net proceeds, and is the net proceeds going to be enough, so that you don't spend a lot of time and money going down the road on a deal that the owner's not going to take and probably shouldn't take. So we say earlier is better. Have those conversations and get educated about your company, the valuation of your company, the tax incentives or the tax issues that will be, generated by this potential liquidity event. Does that answer?
It does. Thank you. And again, I encourage attendees to send me your questions, and let's make sure that if the questions are not answered as clearly as you would like, that you're letting us know. Please continue, Ron.
Okay, thank you. So what are the areas of expertise that we bring to the table as a banker? Certainly, we engage with those investors and those buyers to properly position your company in the marketplace. That's one of the keys to being able to get a successful deal at a successful multiple that the owner wants to do. It's to making sure we've got it positioned properly. Also, a banker's going to handle the legwork. One of the biggest distractions that companies have, and we've seen it time and time again, is the companies get focused on trying to get a deal done. They take their eye off the ball, and the next thing you know, the company's gone sideways. So bring somebody in so that you can focus 100% of your energy and time on running and growing that business. Because if you miss those projections, the whole thing's going to have a problem. Negotiating hundreds of deals. This is always my favorite one. I don't know if anybody has seen the commercial where the surgeon is making his rounds the night before the surgery, and he goes into one of the patient's room and said, "Are you nervous?" And the patient said, "Yeah." And the doctor turned around and said, "Yeah, me too. I've only done a couple of these." So we don't want to hire a banker that basically has only done a few deals. You want somebody that's done hundreds of deals and seen all types of situations that they can handle for you. The next is really bring somebody in with the investor network. When you look at the databases that we have and the amount of data on companies worldwide, it's foolish to be able to try to take a company out on your own and get it into the market. You just don't have the data. You don't have the databases. So you want to make sure you're bringing somebody in that can expose you to the strategic partners, to the private equities, to the family offices, to high net worth individuals, because every one of those groups will price your deal differently depending on how it affects them. The other areas you want to look at is it strategic or do you want a private equity? They're very different groups. You know, strategics certainly will generally pay a higher premium because there's the synergies involved. Unfortunately, a lot of times they want to own 100%, but they can also come up with less complex deals. So, is the other thing you want to look at is what position is this deal going to provide for the buyer? Is this a roll up? Is this a strategy? How long is the time frame on these deals? What kind of premiums can a synergistic buyer bring to the table, and can they rationalize increased values easier? They certainly will, much more than a private equity player. I mean, a private equity player has really got one focus. They want to buy the company cheap. They want to keep it for a few years. They want to sell it for more money. That's really their goal from start to finish. And if they feel like they can do that, they're going to buy it at the best price they can. They're going to run it for 2 or 3 years, maybe 5, and then they're going to put it back on the market. And if that's okay and you're exiting 100%, okay, you don't really care. But if you're not selling 100% and you're staying in, these are the things that you really want to understand about, your buying universe.
Ron, before you go on, may I ask you a follow-up question about that?
Yes.
What would be a situation where you might be advising a client to consider a private equity buyer as opposed to a synergistic strategic buyer? Where have you seen that work very, very favorably, if both are on the table?
Yeah, I mean, where it works well is when you're looking at a roll-up strategy. You've got a consolidating industry, and you've got a great management team that's running a great operation in the industry. They're probably in the tops. That's a great strategy to bring an equity partner in, because you're going to buy and build the business. You're going to buy other businesses. You're consolidate them. Private equity firms love that model. But that's not a model that's going to work well with a synergistic player. They're going to look at, do you give me entry into a market that I'm not in today? Do you open up doors that I don't have today? They're going to look for other areas to invest in. So again, that's why I say, before you go to market, you really want to understand your strategy, because those buyers are very different and they're going to look at very different things, and they're going to price your deal very differently. Okay?
Thank you. Please continue.
Okay. What are the pitfalls that we see as bankers, often, really? First one, obviously, is loss of control. The inquirer or the investor just, they drive the process and they drive the schedule. It never works well for the owner. You have to maintain control of the schedule and the process. Poor deal management, not committing to a process and spending more time over shopping the deal. There needs to be a timeline, and management and the bankers, everybody needs to commit to that timeline and the process, and then drive it as hard and as fast as you can. The other areas are weak documentation. We see a lot of letters of intents that really just have wide ranges of opening issues. You never really want to sign into a letter of intent or any kind of agreement when there's too many open issues, because it's just going to give the buyer or the investor too many ways to come back and renegotiate the deal. And that's what we see. We see people come back and want to retrade the deal all the time because really they're just using due diligence as a way to get in and find some issues that they can come back and undercut your price. So make sure it's tight, make sure you clear all the open issues before you go to market, and then make sure you limited access. Again, one of the big things we see is companies give away that management too many meetings and too many visits. They give too much access to the buyer. There needs to be a very straightforward and timeline on when you're going to make meetings. What are the hurdles that companies need to jump through to have a meeting? Before you go, and a lot of times we make them have an LOI on the table just so we know what the range of price is going to be. We want to know when the potential closing date can be. All those things, you really want to box it in before you start setting a lot of management meetings. Again, it's very distracting for management. And you don't know what they're really doing. Are they looking for secrets? Are they looking for, to find out how you're doing it better than them? So you really want to minimize access to management in meetings as much as you can. The other areas that we come across is loosely defensible valuations. People come up with valuations, but they don't have the hard data and the facts and market intelligence to really support that valuation. It's easy to come up with a valuation. It's not always so easy to support those valuation numbers. And so you really want to make sure you've done your homework, your banker's done the homework, so that when we get into the valuation discussions, which you always will at some point in time, you can defend it. And you can show how you came up with your price. The last is you never want one date for New Year's Eve. You always need to have competitive sales. You want to have a competitive process. It's the only way you're going to really achieve the kind of multiple or the kind of premium that you're going to want. You got to have more than one term sheet on the table. So those are some of the pitfalls we've seen. I'm sure there's many others. And there's my commercial.
Okay.
Thanks,
Yes.
Teri, for giving me the time. Thanks, everyone, for giving me the opportunity. I hope we have plenty of good questions.
Yes. So please get your questions in now. I'm going to, in the meantime, ask one of my questions. Ron, how's your sourdough bread baking coming along? In other words, what are you doing to help best ensure your positive mental health during COVID?
Well, it's an interesting question, that's for sure. I certainly have spent a lot more time today. I mean, 120 days ago, I didn't even know what a Zoom was or who a Zoom was or how to Zoom anybody. So definitely today, and especially because our clients are really all over the globe, I spend a lot more time every day right here doing this, with customers and with potential clients. And, I think the more interaction you can have, I think it's more healthy. So I like to stay in front of people. I like to stay in front of groups like yours because it keeps me actively thinking about, what are the next steps? What do we need to do moving forward?
Thanks for that. Just checking to see if I'm seeing another question. Do you think many of the mergers will be heading towards a monopoly and lead to many smaller consolidations to try and fend off the Goliath?
I think we're coming up on a period where the government, especially if the Democrats get in, are going to step in and start breaking these monopolies up. We've reached a period where it's time to basically take some of these big companies and begin breaking them up. So I think it's going to get harder and harder to do getting these deals closed, especially if it even smells or looks like a monopoly. I think it's going to be tougher to get it through the regulators than we've seen in the past.
Okay. Does the decrease in private equity firms represent a consolidation in that industry? Is there a class of targets that the private equity firms are looking for?
Yes, definitely a consolidation. I mean, you went, as I say, from 660 private equity firms down to 220. So there's been a real consolidation in that business. Now, what we don't know today is the consolidation been in certain industries, or is it due to the portfolios they had? We don't really know what the COVID impact on their portfolios have been. Some of them will be devastated because maybe 7 out of their 10 companies, is going to go away. Others, maybe it's 2 or 3. So, I think what we don't know today is we know that there's consolidation in the private equity. What we don't know is that in industries.
If you were guessing from your industry intelligence and experience, which industries are you thinking you might be seeing more failures, more consolidations?
Well, it goes back to the one slide, right, that I put together for, survive, thrive, or dive, right? I mean, those are the industries. And so when we look at industries that, you know, touch, it depends on how they deliver the business, right? I mean, if you're a business that you have to deliver your business to the to the customer in person, those are going to be very tough businesses moving forward. So people like gyms, people like restaurants, that's going to be a tough business. So what you're going to see that survives is any kind of business that can deliver their service or their product without having to be in the same location. And so that's really how we look at it. What fits these fundamentals, right?
Yes, understood. Let's see if there's any other questions coming through. I'm not seeing any right this. Oh, there we go. Is there a viable model where a business would just take a 1-year holiday and then come back to their business at previous levels?
Wow, I think it's a tough one. I mean, there's very few market businesses that can take a year off. Really, they can take even 3 or 4 months off and then come back. That's a tough business model. I mean, to me, you would be better off just selling out, taking your cash, sitting on the sidelines, and wait for a different opportunity in the next 12 to 24 months, because there'll be plenty of them.
And you have talked about those opportunities, which is kind of exciting.
Yeah, I think it's going to be exciting. I mean, as I say, there's always tremendous opportunities that's created in these types of, downturns.
Right, let's see if there's any other questions coming through. I'm not seeing any right now. So I will, let's continue. I'll switch over again. And Ron, you're still there?
Yes, I'm here.
Yes. And hello.
There you are.
Ron, I want to thank you for generously sharing your time and expertise to address these critical and timely issues relating to the financial survival, adaptation, and success of our businesses and or our clients' businesses.
Right.
Ron has agreed to share his slides, which will be available. I'm sorry, Ron, you were saying something.
No, absolutely. Anybody that wants them, please email, or I'll send them to you, and you can email them to anybody. And if there's questions, I'm happy to, have a phone call or whatever I can do to help.
I think there may be another question. Let me just see. No, okay.
Yep, looks like everybody got off.
Yeah, good, okay.
Okay. Oh, I
So
hope
Ron,
that went well.
he's agreed to, so LINKCO Executive Search provides elite companies with top CXOs and upper management nationwide using a proprietary step-by-step process for both clients and candidates. We are on 24/7, 365. When you need help, please call upon us. The next webinar is in 3 weeks on August 26th at 2 p.m., The Dramatically Changing Office with Chris Mays, the Los Angeles Managing Partner, More Partners. This webinar will be posted on my website shortly. Please reserve your seat and stay tuned for additional topics and speakers. And please let me know what topics would be of use for your business sector. And the registration links can be found on my website, www.linkco.net, and in the events section of my LINKCO LinkedIn page. Have a good morning, good afternoon, and evening, and stay safe. And thank you for joining us today.
Thank you.